Well, hello everyone, and hope you're all having a great Wednesday. We're broadcasting live from San Diego, California, and we want to thank you so much for joining us tonight. My name is Jean McDowell with TradersCoach.com, and welcome to Wednesday Night Live. Looks like we've got folks from all around. We've got Ron from Green Acres, Florida, and Ken from Phoenix, Arizona, David from Melbourne, Australia, and folks from everywhere. We even have Tiz from San Diego, right up the block. Great to see you all here, and hope you're all having a terrific evening. With that said, I'd like to tell you a little bit about Wednesday Night Live. It's designed to bring you an expert guest educator each and every week. That way you'll have access to a variety of trading ideas and methods, and you can stay on the cutting edge. Every Wednesday at 7:30 p.m. Eastern, we bring in an expert to talk to us about different topics such as technical analysis, money management, trading psychology, and more. We've got a terrific event tonight all about Elliott Wave, and I can tell you that Elliott Wave is a topic that is near and dear to Bennett's heart. And for those of you that are Elliott Wave fans out there, I know you're going to love this content and this information that we've got tonight. And those of you that are newer to Elliott Wave, I think it's going to really make Elliott Wave easier for you to understand. Presenting tonight, we have Bennett McDowell, who is the founder of TradersCoach.com way back in 1998. Bennett is an expert in technical analysis, money management, Elliott Wave techniques, and trading psychology. He presents the TradeStation Morning Market Briefing every Wednesday, and in addition, TradersCoach.com has received numerous Stocks and Commodities Reader's Choice Awards. McDowell has written 4 best-selling books: The Art of Trading, A Trader's Money Management System, Survival Guide for Traders, and Elliott Wave Techniques Simplified. And without further ado, ladies and gentlemen, here he is, Bennett McDowell.
Jean, thanks so much. Great to be here. Welcome everybody to tonight's webinar. All right, we're going to talk about the Elliott Wave, the roadmap of the markets. I've been trading it now for over 20 years, and I can tell you, if it didn't work, I wouldn't be using it after that amount of time. So trust me on this, it is an excellent tool for forecasting target zones because, you know, when you use the ART software and you use a lot of our tools, they are reality-based tools. But the great thing about the Elliott Wave, using it the way we teach you, it is great to teach you how to use target zones so you get a good idea of your risk to reward and so forth. So we're going to talk a lot about that and how to use the Elliott Wave today. It's a fun topic. Feel free to ask questions. I'll answer them just as soon as I can during the presentation. All right, let's get started. First thing, presentation disclaimer. We cannot do a webinar or talk about the markets without first discussing a little bit about the risk. Without the risk, there is never any opportunity, and that goes with everything we do in life, doesn't it? So you have to understand that there is risk in trading. What we also do is try to control that risk in the best possible manner we can. So that's very important, and you also want to be able to trade in a relaxed environment, and also don't trade money you can't afford to trade. I think that causes a lot of people problems as well. So just realize that we're going to look at a lot of charts today, but I don't know your personal financial situation, so if there's anything you'd like to see here that you may be interested in trading, please check with your financial advisor who understands your personal financial situation. All right, Jean introduced me, and thank you, Jean, for doing that. And again, we would like to welcome everybody and also invite everybody over to our website at TradersCoach.com. We got a lot of cool free stuff there, so drop over whenever you want to. I've also written 4 books available at Amazon.com as well as Barnes & Noble and the major bookstores, and they range from everything from money management to using the ART software to running your business as a professional hedge fund at home, and also Elliott Wave as well. So feel free to look us up on the Amazon website and check out the reviews as well. All right, Jean's going to put a link up in the chat area right under the TradersCoach.com website regarding our free cheat sheet for the Elliott Wave. So I really urge everybody to recommend, this is your bonus for showing up, taking the time to being here. We like to always do that. So she'll get that link up, and there it is, I think, right now. And this basically is what we do with this cheat sheet. It's a 6-page PDF file. and it gives you definitions of some of the characteristics. There's a lot of fib numbers involved, and there's a lot of statistics involved that will be on that sheet for you. So it's very handy to have that right on your desktop when you need it. All right, so go ahead and download that at any time. All right, let me start out with a little background on the Elliott wave itself. And in order to do that, we have to start with the guy himself, Ralph Nelson Elliott. Now, Ralph was born way back in 1871. I don't think there was a lot of computers back then. So he was basically a pencil paper kind of guy. And he actually was an accountant. He almost died in 1929. And during his recuperating process, it's actually when he got involved in the financial markets. So he studied the stock market and the Dow theory. There were no fancy derivatives back there. And in 1932. And he ended up writing some literature, and one was called The Wave Principle in the year of 1938, and his final Nature's Law was published in 1946. And believe it or not, he died just a few years later in 1948. But he started out as an accountant. If he had never gotten sick or in the brink of death, so to speak, he would never have really looked at the financial markets or had the time to study the financial markets to discover the Elliott wave. Now, why use the Elliott wave? Well, we use it, like I said, to forecast price movement for profit. We like it for these target zones, establishing target zones. It encompasses mass psychology into technical analysis. So what Elliott observed was that trends move in waves or patterns. You know, when you look at a chart, you see the market move up, you see the market move down. These patterns, okay, show up on charts, and if you look at the history of trends and so forth, what he found is that they move in series of 5. So all trends moved in these 5 wave sequences. And we're going to dissect that a little bit more in just a little while in this webinar course. But that's what he noticed. We also use it for risk-reward calculations. So that's really important too. So when you're about to take a trade, you can know where your target zone is, and of course using the ART software and the software that we recommend using for risk control, trade size calculator and so forth, you can know what your risk is going to be before you enter the trade, and if you know what your target zone is, then you can make that calculation for your risk to reward. So good stuff, and we really like to call the Elliott wave basically the roadmap of the markets. But what is it? What is it exactly? The Elliott wave principle is a form of technical analysis that investors use to forecast trends in the financial markets and other collective activities. The wave principle states that collective investor psychology, also known as crowd psychology, moves from optimism to pessimism and back again, the cycles of the market. These swings create patterns as evidenced in the price movement of a market at every degree of the trend. Elliott's model says the market prices alternate between 5 waves and 3 waves at all degrees of a trend. And we're going to kind of make that a little clearer with some diagrams in just a minute. So let's take a look at Apple stock here for a moment. And this was something that occurred a little while back in Apple stock, a couple years ago. And we were tracking it right along. But what I want to basically show you with this is that there are major waves and there are minor waves inside all the waves of an Elliott wave. It's kind of like a snowflake. You have a snowflake and you put that snowflake under a magnifying glass and there's crystals. You put those crystals under and you start seeing snowflakes again. So same type of thing with the Elliott wave. There are waves inside waves, and sometimes we have to go to lower time frames to see these waves inside these waves. But in this case here, we can actually get a clue as to the workings of the Elliott wave. And so this was such a great example. So the trend starts here. We'll call this point 0 on the far left-hand side of the chart. And our first move up is wave 1. Notice we have also these little numbers here. 1, 2, 3, 4, 5. So waves 1, 3, and 5 are called impulsive waves. And one thing that's very important to note is that in a trend, you have 5 waves and then the trend is over. Waves 1, 3, and 5 all move in the direction of the trend. But you also have corrective waves, which are waves 2 and wave 4. And these are not impulsive waves. These are what they call, once again, corrective waves. And inside the impulsive waves, there's always 5 waves of a lesser degree. And so that's what we've labeled with these smaller numbers, 1, 2, 3, 4, and 5. So when you learn about the Elliott wave, the way we teach it, you're going to learn how to look at charts and count it this exact very way. Notice the corrections have ABCs too. And then when you get to top of 5 on this actual Apple stock, then look, the market took off. So that just gives you a overall brief example of what we mean when we say there's 5 waves in a trend and there's little waves inside of waves. Now, one of the interesting things about Elliott wave is that most people think it's very mystic and so forth, but it's really a case of observational statistics. Now, what do you think I mean by that when we talk about the Elliott wave? Does anybody have an idea of what I mean when I say observational statistics? It's a tough definition, isn't it? Well, let me just expand upon that a little bit. A great analogy is that of what we find in astronomy. You know, astronomers look at black holes, and they know when matter gets close to it, a certain distance, matter gets sucked into the black hole. But you know what? They really don't know where the matter goes. They can guess, but they don't know where. And they really don't know much about black holes, but they observe that when objects get close, they get sucked in, and that's the end of it. Well, that's called an observational statistics because you really don't understand black holes well enough to explain why that happens, but you observe it. Same thing with the Elliott waves. So what Elliott did is he observed these patterns. He didn't necessarily understand exactly why crowd psychology and so forth creates 5 waves, but he noticed 5 waves in a major trend. So that's an important clue as to observational statistics. Now, Elliott was the founder of what we also call classic Elliott wave theory, but there is something else since the advent of computers, and it's called the modern approach to Elliott wave theory. And so when we combine the two, we get a very, very potent mix of probability. And that's what we're going to focus on when we talk about the Elliott wave. So if a lot of you out there are thinking that the Elliott wave can be subjective, what we do by combining the Elliott classic and the modern approach to Elliott wave is try to take that subjectivity out. So let's see how we do that. Before we actually work on the modern approach, let me just go over a couple things you need to know about the classical approach. All right, we already looked at Apple chart and we saw the waves inside the waves. But this chart here in front of you goes into that in a little bit more detail. And notice here that on the left side we have a monthly chart, a yearly chart, and then a 5-year chart. And so notice here are the smaller waves, 1, 2, 3, 4, and 5 ending. And then we have an ABC correction. Notice the red 1 and 2. Well, when we look at a year chart, we see that imposed right here where that 1 is this and that 2 is there, which is part or inside a larger trend on a longer term chart. So even though this looks like a long-term chart, and it is a monthly chart, when we also now look at a yearly chart, we actually see that the monthly chart is a smaller pattern inside that yearly chart. So this is kind of similar to when you look at a daily chart and then look at a 60-minute chart, and you're looking at the 60-minute chart for the smaller pattern inside the daily chart. And then note here, we even now go to a 5-year chart, and once again, what they do here is here's the 1 here that correlates to the 1 here, and the 2 here that correlates to the 2 here, but they really make up, again, waves inside a larger situation. So that's important to understand about the Elliott wave, that they're in sync, and they call that fractal symmetry. by the way, which means that there's patterns inside patterns, and you see these patterns reoccurring on different time frames. And here's an example of it again, where you have a wave 1 up, and then you have the smaller waves inside, ABC correction on the corrective waves. Remember, the corrective waves are not impulsive waves, so they only have an ABC correction. And then we have a move up to Elliott wave 3, and again, that's 1, 2, 3, 4, 5, because that's an impulsive wave. And then a corrective wave down to 4, and then another impulsive wave of 5 waves to make up the last impulsive wave of the trend. So when we get here, then the trend changes. All right, so that's kind of one thing you need to know in terms of classical Elliott wave approach. Now here's just a little bit more of that inside a clearer print here for 1, 2, 3, 4, 5, okay? And here's the corrective waves. And what's kind of interesting about this is notice that A and C are impulsive waves on the correction, so there's even 5 little mini waves in those too, whereas the B wave is an ABC, even though the whole thing makes up a correction. All right, so that's kind of the basics of the Elliott wave, and here we have that example again, and here we have some complex, little different types of corrections. How many people out there have at one time in their trading or the other notice what we call a either a flag or a pennant in the markets? A flag or a pennant. Yeah, a lot of people, okay? So you usually see these flags or pennants form in what we call an Elliott wave 4. They can be in 2 as well, but we usually see them in 4. And basically they are the result of what we call a complex correction. And it's usually when we have an A, B, C, D, E formation, and then it breaks out. So in this case, we have an A, B, C. So if you had a wave 3 up here, top, A, B, C, D, E, boom, and then it goes to a 5. At the bottom here would be a 4, okay? So E represents the bottom of 4. That's a bullish one, and this would be a bearish one, okay? But they usually break in the direction of the Elliott wave count. They're fun because when you see them, it's a pretty explosive move. Okay, here's another example of a channel. I mean, we've all seen channels in the market, and usually when a channel forms after a wave 3, and sometimes even after wave 5, you can have a correction before it goes into the next trend, we see a channel. And these are these ABCDs going back and forth and back and forth. So they look a little different. Here's another one here, expansion. This is called an irregular complex correction. So there's different types of corrections. The most common is a simple A, B, and C. Now, the major criticism that most people have of the Elliott wave is that many feel it is subjective. In other words, you know, when you go to analyze it, there can be multiple wave counts and so forth. So we're going to talk to you a little bit about how to take the subjectivity out of wave counting. That's our goal, and we've been very good at it. And to help us do this, we bring in what we call the modern approach of Elliott wave analysis. So up to now, we've pretty much focused on classical. Now we're going to talk about the modern approach. And by combining the classical and the modern approach, you actually increase your odds of success. The way I've done this is I've developed a way in which I've added several key studies, and these components significantly increase the probabilities of accuracy in counting the Elliott waves. Now here they are. First one, we take all the stuff we learned with the classical approach. That's step 1. All right? We're going to add into their Fibonacci levels and using the computers to help us draw them easily. All right? We're also going to introduce you to some indicators that help confirm Elliott wave counts, and I'll show you those a little bit later. All right? Fractals, we'll talk a little bit about fractals, which are found in both nature and in the Elliott wave. What's a fractal, by the way? Does anybody know what a fractal is? Anybody? Tiz, I think you had a question on a fractal. What's a fractal? All right, usually a fractal, what it really represents, okay, is usually a change in behavior. And so in the markets, they usually represented a pristine fractal will look like this, basically a pivot point. So you had bullish behavior, moving it up, and then something changed it, and then you had bearish behavior moving down. So this area here is the fractal or pivot point that really represented the change in behavior. So fractals are found in markets every time the market surges, goes down and retraces. Those are all areas of fractal, okay? Fractals. All right, volume. That's another thing to look at. Volume. We notice that, of course, in wave 3, we have the most significant volume. We also have the most significant momentum that we measure with the OWL indicator. Price compressions, we briefly looked at those already. We see those during the corrective waves. But here's something we haven't talked about, the probability matrix. And what I did with this is my goal for this was to assign percentages to each one of these, I'll call them dots up here. And when you do that, you create a percentage of probability based on what these items are indicating or confirming. And so from doing that, then you get a probability matrix of the accuracy of the Elliott wave count. And then, of course, another connecting of the dots. You can't do anything in the markets without risk control, and that is trade entry. Okay, so we talk about that as well. So the Elliott wave, let me just talk a little bit about grounded versus ungrounded assessments and what that means. When we talk about grounded, these really mean very strict risk control. So grounded, for example, a grounded assessment is if you're using the applied reality trading software, the pyramid is giving you an entry at the apex and your stop loss is one tick under the base leg. That is based off the reality of support and resistance in the market. That is a hard-based grounded assessment. Now, an ungrounded assessment is something that we're using a theory to actually make an assessment of the market. For example, Elliott wave is an ungrounded assessment. It becomes grounded when it becomes reality. But when we predict target zones and so forth, those are all based on the accuracy of the Elliott wave account and what we think it will do. But it is considered an ungrounded assessment. So you have grounded and ungrounded assessments, and we need risk control for both. So it's really important to have a good risk control program in place for each and every trade. All right, now this is the question I love a lot, and I call it the million-dollar question. Everybody goes, well, does the Elliott wave work? Well, again, it works as long as you know how to use it. And I think one of the key things is establishing the probability matrix. So when analyzing the markets, using the techniques you have now learned, you can create this probability matrix that will allow you to connect the dots and place a probability in the accuracy of your forecast. And that's what makes the Elliott wave work. There are 6 areas, again, we focus when forming the probability matrix. We take into account the price structure. Is it clear? In other words, is the classical approach making sense? Do we see waves inside the waves like we should on the lower time frames and even the higher time frames? All right, do we have a price oscillator histogram that is clear? Okay, and this, we've come up with a more modern piece of software called the OWL to take care of this. All right, is volume correct in each wave? You should always have the highest volume in wave 3. Are Fibonacci levels holding? In other words, did we get a retracement down to the proper level for wave 4? Is the relative strength index, which is also, is that clear? And we've created the PTF software from that as well. Multiple time frame alignment is in sync. In other words, the lower time frames, the waves inside the waves. So once you have these 6 in alignment, the probability of the accuracy of your wave count goes extremely high, and that's what we want. That's how you take the subjectivity out of the wave count. Now, if you look on this chart here, and again, this was Apple. If you look on this chart here, we're going to look at a multiple number of things. First thing is, let's look at price structure. Let's, for a moment, forget the indicators at the bottom. All right, look at this move, the way it tore up here, how fast. Elliott wave 3, from the classical standpoint, is a very fast-moving wave, and it has usually tremendous volume, and the momentum is the highest as well. Then after that ends, we go usually into an ABC type of correction. So A, B, C. And then C wave needs to be in the target zone, and it was. And that target zone is 38.2 to 61.8. We label that as a 4. And from that, then we can use a fib extension to get our target zone for wave 5. And look, it marched right up there and boom, sold off. Now, let's bring into the mix the enhancers at the bottom. So with the owl, notice that we have the highest owl measuring momentum on wave 3, as it should be. Wave 4, notice the owl goes below the 0 line and then creeps above the 0 line on wave 5, as it should. You cannot have a wave 4 without having the owl go below the 0 line. And then notice we have wave 5, which has an owl lower in value than on wave 3. So that's bearish divergence because we have higher prices and we have an owl that has a lower momentum value on wave 5 than 3. And then it crosses over again, and that's the end of wave 5. So you could almost count the 5 waves using the modern approach of the owl. But you see how nicely it confirms it. Okay, that's the key. It confirms it. Now, a lot of times when we scan the markets for trades, all right, we'll find a wave 3 because they're easy to find. The next question is, then we have to analyze where we are in wave 3, and we have ways of doing that. And so once you know you're in wave 3 or wave 3 is just completed, then you know you have wave 4, and then you're going to have another opportunity to trade wave 5. Sometimes, a lot of our trades too, we trade between 3 and 4 too, if we can get in 4 very early. A lot of times we'll find a wave 3 after a long channel, break the channel, and then we start going in with our pyramids when we have a bullish owl as well and catch the beginning of wave 3. So even if you miss most of wave 3, don't fret, because you have a lot of opportunities to trade from 3 to 4 and 4 to 5. We've made a lot of money doing that. Okay, so very exciting once you get this hammered down to a point where you get target zones and really know how to use it. Here it is, for example, on a downtrend. You know, we look at a lot of uptrends. Let's look at a downtrend. So here we have the move down. Okay, we have the bearish owl here. That's the largest owl, and it happens to be negative, so that's a downtrend. We have 3. Then we have 4 moved up here. Little bit of an A, B, C right there. This met the fib retracement, and then we drew in the wave 5 target zone with the fib extension, and now we're going on to 5 here with the red PTF, so it's not quite over, but it's just entering the target zone. Let's look at another. Here's another one on PEIX where we had a wave 3, 4, 5 that are bullish, and we had a wave 3 owl, wave 4 owl. This gives you a great example of how you can really count the Elliott waves by just using the owl. This is one of the things we look at when we talk about the probability matrix. Does the owl make sense? Does a modern approach agree with what's happening on price? And it certainly does. Does anybody have any questions? Do they not see what we mean? I just want to make sure everybody's on board. Do you see what we mean when we say the owl confirms the wave count? I think we're pretty good on that, right? So in order to have a wave 4, you have to have an owl that's negative. And so you can't have a wave 5 until you've had a wave 4. So they all sync up. Now, if you had a little pullback here and the owl didn't go negative, well, then your chances are you're still in wave 3, and this was a minor 4 inside 3. And as Greg says, you know, there are rules to waves A, B, and C like there is for 1, 2, and 3, and 4. Yes, absolutely. And they're pretty hard, fast rules, okay? All right, so right now, what I'm trying to do is introduce you to the general view of why we use Elliott wave and how it kind of works. That's the key here. Now, here was when we used it back in 2002, all right? By the way, this was a huge wave 3, okay? This was in the 1990s. You know, another characteristic of wave 3 is the enthusiasm that's in the market. How many people were trading back in the 1990s? Okay, good, Ron. Okay, good. All right, so some were and some weren't, okay? Do you know you could not go to a cocktail party, and Ron, back me up on this, but you could not go to a cocktail party without hearing somebody talking about trading in the 1990s, especially day trading even, right? Okay, all the time, right, Ron? Okay, it was the most popular, it was like real estate investing was back in the 80s, okay? You could not, everybody was in it. And that's typical of a wave 3, that kind of enthusiasm. Well, you know, then you had the .com, you know, companies were coming out with .com websites in the late 90s, and that would make their stock go up, and the whole market index was rising on that. And then they realized that, hey, you know, it gets to a certain level and reality catches up, things change, the mood changes, the manic bubble that is created can't be sustained by reality, and then you start getting problems. You get a break in the market, which is what happened here. So wave 3 began to decline, and we were waiting for it to happen because you know why? We could see a couple things. One, here's a minor wave 4. Here was 3, 4, okay, into the major 3. So we knew we were in wave 5 of 3 for one thing. The other thing is that the owl, okay, was getting closer and closer to the 0 line to go negative, and it did so right around 2000, all right? And so then the market came down, and we used our fib retracements, and we got this beautiful target zone, all right, right about there. Now, I'm going to tell you another little story associated with this. I was managing money, quite a bit of it, back in those days. And when it started to look like it was going to break, we were starting to predict a $7,500 level for wave 4. Now, Ron, you were back there in the 90s. All right, if you had told anybody when the market was at around, you know, 11, 12, even 14 at some point, if you told anybody that the market was going to go down to that level, they would have thought you were nuts. And I can't tell you how many people just didn't believe it. But that's exactly what happened. And of course, there was events that happen in wave 4 that create this type of thing. So impulsive waves, waves 3, tend to ignore bad news and focus on the good news. All right. Wave 4, which is a corrective wave, tends to focus on the bad news and neglect the good news. And then it gets to a level where things change and go back up. All right, why? Well, some of it may be longs bailing out of the market. I mean, I could come up with 101 reasons. Everybody was, you know, overextended in tech stocks back then because even the mutual funds were, because if you didn't have a tech stock, you weren't in the market basically back then. So there's a lot of reasons why it came down here. But again, we really don't know exactly always why or what's going to make it happen. But the idea is this is where the wave 4, according to the fib retracements, needed to end. And that's exactly what did. And then we had a rally after that. So very interesting how this works out. All right, let me go on here a little bit more. All right, so I just want to go over, once again, connecting the dots, because I think this is an absolutely important part when you talk about doing the Elliott wave in such a way to create high probability wave counts. Again, you need to learn the classical approach. And as Greg says, that includes the statistics and so forth. Greg, I'm going to talk to you a little bit more about the stats and where we have those. Fibonacci levels, okay, price retracements, and how to draw them. We don't draw our Fibonacci, our anchor. We don't anchor our Fibonacci retracements and extensions like other people do. We're kind of unique, and it's based off, again, statistics and what works best for Elliott wave counting. All right, we have the OWL, the PTF, and histogram indicators, fractals, we talk about volume, price compression, and all these items go into connecting the dots, including risk control when you actually take the trade. So all these are included. Now, all these, there's some rules with all of these, and you really need to know those. And so this is what leads me into our next slide, where we actually have a course that teaches all this stuff to you. And it's called the Elliott Wave Home Study Course. It's an online course, but it has, for example, Greg, the rules on impulsive waves, retracement statistics, and so forth. And so Jean's going to put that link up for you in just a minute for the course. I think she's already done that. And click on that, and you can learn a little bit more about what's in the course and so forth. But it's an excellent course, okay? I designed it, I wrote it. By the time you're finished with it, you're going to know the Elliott wave. We've had many people take it. I can't tell you how many great emails we've gotten from people that have taken it and have learned how to do the Elliott wave the right way. The course is online, so nothing is shipped to you. And you'll get a username and you'll get a password to log into it. And that's 24/7. And that's good for life. So you can go back and review it as often as you want. There's over 3 hours of video associated with that. We give you a study manual and a workbook where we actually have you do exercises. We actually walk you through how to draw the fibs. There's complete statistics like Greg likes for all the Elliott waves in there. Okay, so all that's covered. And so it's a very complete course to teach you the right way to count the Elliott wave so you can incorporate it into your trading. So I want to thank everybody for attending today. Great group, all right, great questions as usual. There's our contact information, but I also want to thank you for attending today too. All right, so Jean, back to you. Thanks very much, everybody.
Well, Bennett, that was terrific. Glad everybody could join us for your presentation. I think you really simplify everything in Elliott wave for us. So thank you everyone for joining us, and we look forward to seeing you next week and every week for Wednesday Night Live. Good night.